we have reached accounts receivable, and accounts receivable, an asset. They're financial assets. What are financial assets? Well, if you think of the different categories, you have your property, plant, equipment, you've got intangible assets, your cash, your receivables, investments. These are all financial assets. So receivables, financial assets. Claims held against others, and it can be your suppliers, your customers, for money, goods, or services, something that's due to your company. We generally have accounts receivable, which are referred to as oral promises to pay, and then notes receivable, which by definition have to be written promises to pay. That's not to say when you go to take out a, like with my construction company, I go to the lumber company and say, yeah, I'd like to have a $100,000 credit line. It's not like I don't have to fill out a credit application, so there is a written sort of credit agreement there, but it's not a formal note receivable. So I don't want you to go into a company and say, oh, well, accounts receivable or oral promises to pay, I shouldn't have to, fill out anything here. You generally will, but it's different from a note receivable that is a formal instrument of credit, a written promise to pay. Okay. So you classify them current, non-current. It's an important classification to make because when people are analyzing financial statements, they need solid numbers for their current assets, current liabilities, and such things. We classify them as trade and non-trade. Trade receivables relate to your customers. So you could have accounts receivable from customers, which would be trade receivables. You can have notes receivable from customers, which would be trade receivables. In some businesses, for instance, when I go out to buy my tractor loader backhoe for $30,000, they're not going to say, oh yeah, take it, we'll send you a bill. They say, no, you fill out a promissory note here to Kubota credit. So in a lot of businesses where you're dealing with boats, tractors, big ticket items, notes receivable from customers are standard operating procedure. So trade receivables, accounts receivables, notes receivable that are due from customers. Non-trade are all your other ones, and they can also be accounts or notes. So these could be, the company's loaned money to officers or employees, and they're due from them. It could be loans to subsidiaries, and then there's a whole bunch of other things I list in the notes that it could be. But basically anything that doesn't relate to the customers. Okay, so let's see. All right. What else we've got here? Okay, so we have to recognize, and then we value and we dispose of accounts receivable. So I'll talk a little bit about recognizing them here. The current revenue recognition standard changes the way that we talk about accounts receivable, but the journal entries don't really change that much. The book uses all the new language. This is the standard that came into effect, this year and last year. So if you had AC 101, 102, prior to that, you learned that revenue is recognized when it's earned and realized or realizable. The new approach is more contract-based, and Chapter 18 gets into that, so you may want to just review that from AC 201. Okay, so accounts receivable arise from a revenue arrangement, a contract with your customer. The question you have to ask before you recognize your receivable is, has this performance obligation been satisfied? And you have to have it satisfied, you have to have some indication that the control of whatever you're selling has gone to the buyer, so that you can say, yes, the performance obligation has been satisfied. And there's a whole list of indications that that control has passed that you should just be aware of. Okay, we get into measuring the transaction price. And here's where we get into the variable consideration. The transaction price, you go in, you buy a coffee and donut at Dunkin's, and you pay $5, you're in and out, done. But sometimes there's what's called variable consideration, and that's when what happens depends on future events. And so here's where we get into trade discounts, cash and cash or sales discounts, and things like sales returns and allowances. So what I'm going to do is stop this. We'll stop this one right here, and I'm just going to give some examples using the brief exercise and exercises of the items that relate to variable consideration.